Hello and welcome to this very special episode of Young Turks. I'm Shireen Bhan. As you know, we're just about a month away from our 10th anniversary. And so it is time for us to check in with some of our older Young Turks, people who've gone on to make it very big since the last time that they were on the show. Today we go back to 2004 because that's when Malvinder Mohan Singh was first on Young Turks. Since then, he sold off his family-run pharma business Ranbaxy for a whopping $4.8 billion and today is heading Religare Financial Services and Fortis Healthcare Services. It's time to find out from Malv his strategy on success and the future.
Malvinder Mohan Singh has always chosen to do things differently. Though pharma flowed in his veins, Malv put business before sentiment and sold off his family business Ranbaxy to Japanese giant Daiichi Sankyo for a whopping 10,000 crore rupees in 2008. Sitting on a treasure trove that Malvinder calls his war chest along with his brother Shivinder Mohan Singh, he's now focused on building a new empire. Malvinder hopes to take global Fortis Healthcare, India's second largest corporate hospital chain, and Religare, India's leading financial services brand.
Life has changed for you dramatically since you were last on this show in August of 2004. I distinctly remember then that you had told me that your vision and your big dream was to make Ranbaxy a $5 billion company by 2012. How different have things turned out to be?
I think the company is doing great. The company is in a different set of hands with Daiichi Sankyo at this point in time, which happened a few years ago.
But it's no longer your dream.
Yes, it is not my dream, but it is a dream that everybody shared in the company, and I think they're going to continue to do it. And I think one of the reasons why Ranbaxy and Daiichi Sankyo came together was actually towards fulfilling that dream. So that dream carries on, but it carries on in somebody else's destiny. And I have personally been a large part of it to take it to where it is, and now somebody else will take it forward together.
How difficult was it for you to give up on that dream? This was a company that was built by your grandfather, by your father, and then you spent significant amount of your own time, your energy, taking the company to where it was when you finally handed it over to Daiichi Sankyo for a lot of money. I know you have said to me in the past that you don't get emotional about business. How do you manage to do that?
Clearly, over the last few years, the pharmaceutical industry globally, the landscape has changed very differently. And I was convinced that if we had to pursue and follow that dream to make it happen, it was imperative that we change the business model. We changed the game. And the game change primarily meant aligning generics and innovation together, bringing emerging and developed markets together, redefining the way you give your proposition of products to the payers, which in developed markets are basically governments or insurance companies. So you needed to straddle the markets and the positioning in a very different manner to succeed in the future.
Sure. While I understand the argument that you've often made about combining generics and innovation together and then going to the market, a lot of people would see your move as a prudent move, that things were not really going to work out to your advantage at that point in time. Things were only going to get tougher as you moved, and hence the decision to actually offload Ranbaxy because the environment around you was getting much tougher. So in a sense, it was prudent, practical, and you made a lot of money off it.
Let me put it to you differently. We have a mission to become a research-based international pharmaceutical company. It needs $1 billion, $2 billion, $3 billion of risk capital and a very strong balance sheet to start to make that move. I think India as a country and us as an industry in India are very far away from bringing and getting that capability to the size and scale that you wanted. So what we are very good at is generics, is doing generics at a higher differentiated level and playing the game in a cost-efficient manner. So getting innovation and generics together, to me, strategically made sense, and it was certainly the right thing for the company to do to be able to achieve its vision. In order for that to happen, the way the structure evolved, it meant that I, as a family, we moved out our shareholding. We had to create that delivery mechanism of getting those guys in to get to a 65% shareholding. So yes, we sold out, but every single moment that I spent in Ranbaxy, that I saw Ranbaxy as a child, have been moments which I've loved, I've enjoyed, and the learning I got personally as an individual, as an employee, as a boss, was absolutely fantastic.
Okay. I want to ask you a personal question. When you finally took the decision to move out of Ranbaxy, what was going on in your head? Did you think that your father would have approved of this decision?
I'm not quite sure I can really answer that, but I know one thing. He would have certainly done what was in the best interest of Ranbaxy, and that's what I believe I did.
Let me now talk to you about where you currently are, and that is as the chairman of Religare and Fortis Healthcare. A couple of years ago, you'd spoken about how you would like Religare to have a couple of $1 billion in assets under management, and since then, you've gone on to do several acquisitions. What now is the plan as far as Religare is concerned?
Let me step back for a minute. There are really 5 broad things that I've always looked at when we're looking at business. One is to make sure you're at the forefront of every business in which you are.
So you believe in the Jack Welch philosophy of being number 1, number 2, number 3, or not being there?
You have to be at the forefront. This is something I've seen my father do. I've seen it in Ranbaxy. I've lived it. Within that, also to ensure that you are the leader in your home market. At the same point in time, I think for me, business is not about just making some profit and being 10th, 15th, 20th in those rankings, and just to have an earning and have a living. It's about doing things differently. It's about making sure that you're able to go out there globally. You're able to make the change. You're able to redefine the strategy. You're able to put out your finger in the future and say, that's where I see opportunity. That's where the markets are going to be, and I'm going to lead it. I'm not going to follow it.
How do you look through the clouds? What is it that you use to be able to spot these opportunities ahead of the curve?
It is gut intuition, but at the same point, you need to have an understanding of what the business is, where the markets are, where do you see trends, where do you see opportunities, what do you think is going to change. The biggest is not always the best. I think if I look at the last 20 years of my career, I've personally been involved in probably, 40, 50 acquisitions, which is a lot.
You enjoy that, don't you?
I enjoy it. But you have to be able to do it at a particular price point and add value. You cannot get too emotional and too involved in a deal where you lose objectivity. And objectivity in such matters, and particularly in business, is very, very critical.
That's what led you away from the table as far as Beta Farm was concerned, which then has been
Merck AGA, a clear decision on Ranbaxy, a clear decision on Parkway. All of those have been examples of following a very clear, disciplined, and aggressive, a quick but a disciplined approach in business.
One of the things that I think has been appreciated, especially when you are on this aggressive global expansion path on the healthcare side, is that you haven't used Fortis Healthcare as the vehicle to fund your global expansion plans. It's actually your money, the promoter family's money, that's being used to fund your global acquisitions, your global buys. Why did you feel that you needed to take that decision? Because if you were confident of the fact that you would be able to deliver on the kind of returns that you anticipate, then why not use Fortis, the Indian arm?
The Indian healthcare market is huge. Today, the healthcare business, if you look at the organized hospital market, there are only 1% of hospitals which are above 200 beds. There are 5% above 100 beds. And we are not there. I mean, even if we have 55 hospitals and we're amongst the largest in the country, we're not there deep enough to say we are really penetrating and providing service to the people across the country.
So then why the decision to look outside before you actually penetrate even further into India?
Because this will take 20 years. This will take 15 years.
But by picking up stakes in, a hospital in Australia, a hospital in Sri Lanka, are you actually going to be able to deliver the kind of value that Fortis is attempting to deliver in India globally?
We're looking at being a integrated healthcare company across multiple markets. Firstly, you don't have a global integrated healthcare company. Secondly, you don't have a healthcare business in healthcare delivery services across multiple markets and multiple continents.
So what gives you the confidence of being able to create this global healthcare integrated model?
It's a vision. I believe it's doable. It's certainly challenging, but that makes it exciting. That makes it fun. And that's where I am today personally spending my time in making it happen.
Photography was something that you did in 2004.
Lots of it.
Do you still do that?
Photography, I've kind of just got back into it and I'm enjoying it because now it's more about people, it's about portraits, it's about expression.
Gotten a bit philosophical, haven't you?
I guess
in your old age.
slightly grey.